Okay, students, another MTQ. The following scenario relates to question 16 to 20. E-company is preparing its financial statement for the year ended 31st March 20x7. Remember, the year end for the company is 31st March 20x7. The year end is 31st March 20x7. Then what will be the year start for the company? It will be 1st April 20x6. Remember the year start and the year end dates. The year end date is 31st March 20x7. It is 31st March 20x7. What will be the year start for the same company? It will be 1st April 20x6. So the year start is 1st April 20x6 and the year end date is 31st March 20x7. Okay. The following issues are relevant. First one, the project Orion. The project commenced on 1st April 20x6. What is the year start for the company? For the E-company, if the year end is provided by the examiner that it is 31st March 20x7, then what will be the year start for this company? It will be 1st April 20x6. Now the examiner is talking about the project Orion. It is the project Orion. And the project Orion start on 1st April 20x6. It start on 1st April 20x6. It means that the project commenced at the start of the year. The project commenced at the start of the year, right? And incurred total expenditure of $18 million during the period to 31st December 20x6. Incurred evenly throughout the period. Okay. The total expenditure which is incurred on the project Orion is $18 million. It is the total expenditure, means the total cost. It is up to 31st December 20x6 and it incurred evenly throughout the period. Evenly throughout the period means same every month. Same every month. If the total cost is $18 million, look, if the total cost is $18 million, the project commenced on 1st April 20x6 and it is up to 31st December 20x6. So April, May, June, July, August, September, October, November, December, total of 9 months. Evenly throughout the period means same every month. Divided by 9, so it is $2 million per month. $2 million per month. Okay. On 30th June 20x6, management concluded that the project satisfied the recognition criteria for capitalization in accordance with IAS 38 intangible assets. Okay, so let me make a separate working for this right here. Okay. It is the project Orion. Okay. The year start for the company is 1st April 20x6, while the year end is 31st March 20x7, right? And the project starts on the same date on 1st April 20x6, and it is up to 31st December 2006. On this date, the project is completed. Now, the recognition criteria met on 30th June 20x6. Mean 30th June 20x6 mean on 1st July 20x6, right? If the examiner give you the end date, so it means that it is always at the start of the month, right? So if the criteria met on 30th June 20x6, so it means that we can assume that it meets on 1st July 20x6, right? Okay. So I will write okay. So I will write the same date. Okay. It is 30th June 2006 on which the capitalization criteria met. So it means that no criteria was met for this period. No criteria was met for this period. So any cost incurred in this period will be directly expensed to profit or loss. no criteria is met for this period, so any cost incurred on this period will be expense to profit or loss, right? So now, what was the total cost which we calculated for the month? It is $2 million, right? It is $2 million per month, $2 million per month. Okay. Now, if it is $2 million per month, multiply by April, May, June. So multiply by 3, a total of $6 million will be expense to profit or loss. It will be expense to profit or loss. Now, when the criteria met and the project completed, any cost incurred in this period will be capitalized. So it is from July, August, September, October, November, December. Total of 6 months, $2 million per month. Total number of months are 6. So a total of $12 million will be capitalized as an intangible asset. It will be capitalized as an intangible asset. Now, look again. Okay. The first project was the project Orion. It was commenced at the start of the year because the year end provided by the examiner is 31st December 20x7. So the year start for the company will be 1st April 20x6. The project commenced at the start of the period, which is 1st April 20x6. Total cost of $18 million was incurred up to 31st December 20x6. Total cost is $18 million. Now the examiner is telling you that it is incurred evenly throughout the period. Incurred evenly throughout the period means same cost every month. So there are a total of 9 months. Total cost is $18 million. So 18 million divided by 9 is equal to $2 million per month. On 30th June, management concluded the project satisfied the recognition criteria for capitalization in accordance with IAS 38 intangible assets. So criteria met on 30th June 20x6. It is right here, 30th June 20x6. So any cost incurred before the capitalization criteria, it will be directly expensed to profit or loss, right? And the cost incurred after the capitalization criteria and up to the project completed will be capitalized as an intangible assets. So the pre-capitalization period is 3 months and the post-capitalization period is 6 months, right? Okay. Now, the project was completed and become available for use from 1st January 20x7. It is expected to generate economic benefit for a period of 6 years. Okay. So it was immediately available for use. So we will start amortization immediately. Mean it is immediately available on 1st January 20x7. So we will start amortization directly, right? So how we will calculate the amortization expense? It's very simple. It is the cost divided by what is the useful life? It is 6 years. It is 6 years. So 12 million divided by 6 multiplied by January, February, March. We will charge amortization expense just for the 3 months for the current period, right? It is for the period 31st March 20x7. Okay, so 12 divided by 6 multiplied by 3 divided by 12. So it is 0.5 million dollars, right? So it is the amortization expense. Now, if you want to calculate the carrying value, so it's quite simple. Cost minus amortization. It is $11.5 million. Clear? It is $11.5 million. It is the carrying value, while the amortization expense is $0.5 million. So this was all about the project Orion. All about the project Orion. Now, let's move toward plant and land. Okay. Plant and land. the carrying amount at 31st March 2087 of plant and land held by the E company or plant measured at a cost less depreciation, means the cost model, it is 220,000, land measured at revalued amount, revaluation surplus, right? Original cost was 400,000 and I think the fair value is 560,000. The tax basis of the asset at the same date were correctly calculated. For the plant, it is 180,000. For the land, it is 400,000. And E company paid tax at 20%. Okay, so it was all about the deferred tax. So let's do accounting for the deferred tax and also find the revaluation surplus, right? So give me a second. Okay, now, okay, the examiner is saying that the carrying amount at 31st March 2087 means at the year end, the carrying amount at the year end of plant and land held by the E company are, for the plant, it is 220,000. So if I talk about the plant and I compare the carrying value with the tax base, right? So for the plant, the carrying value is 220,000. And the examiner is saying in the next para that the tax basis of the asset at the same date were correctly calculated, is correctly calculated. For the plant, the tax base is 180,000. So carrying amount is more than the tax base. So it will give you taxable temporary difference, right? And a taxable temporary difference of 40,000. Multiply by the tax rate is 20%. So it will give you a deferred tax liability of 8,000. And the double entry for this will be profit or loss debit and deferred tax liability credited by the same amount. Profit or loss debit 8,000 and deferred tax liability credit 8,000. Clear? So it was all about the plot. Okay. Now for the land original cost is 400,000, while the fair value is 560,000. So the revaluation surplus is 1. Give me a second, please. Okay, it is 160,000. Now, for the land, the carrying value will be the revalued amount, which is 560,000, while the tax base is 400,000. Now the carrying value is more than the tax base, so it will also give you the taxable temporary difference, and it will give you a taxable temporary difference of 160,000. Multiply by 20%. It is 32,000. Now, what will be the double entry for this deferred tax liability? What will be the double entry for this deferred tax liability? Can you tell me what will be the double entry for this deferred tax liability? The difference, if the difference is because of the P&L item, the effect will go into P&L. But if the difference is because of other comprehensive income, the effect will go into OCI. So now the double entry will be other comprehensive income debit, 32,000, and deferred tax liability will be credited by the same amount, right? If the difference, if you remember IAS 12 income taxes, if the difference is because of the P&L item, the effect will go into P&L. But if the difference is because of other comprehensive income, it is because of the equity, the effect will go into equity as well, into other comprehensive income as well. So for this, The double entry will be P&L debit and deferred tax liability credit. And for this, it will be other comprehensive income debit and deferred tax liability credit. If you debit the profit or loss, it will be wrong, right? Because the difference is arising because of other comprehensive income, because of the revaluation surplus. Now, if the examiner asks, what will be the revaluation surplus? What will be the revaluation surplus at the end of the year? Means after the deferred tax, so it will be 160,000 minus 32,000 is equal to 128,000. Clear? Now, if the examiner asks about the total deferred tax liability, so one is 8,000 and the other one is 32,000. So a total deferred tax liability of 40,000. But if the examiner asks about the tax expense in profit or loss, it is 8,000, and in other comprehensive income, it is 32,000. So it was all about the plant and land. Okay. Now, the last adjustment, it is all about the equipment. So, equipment, okay? And let me make working for this equipment right here. Okay. Now let's start. E-company acquired equipment on 1st October 20x2. It is acquired on 1st October 20x2 at a cost of 120,000. Okay. The useful life of the equipment was 10 years, after which the residual value was estimated to be nil. Depreciation was correctly charged up to 31st March 20x7. On that date, the equipment was damaged, indication of impairment. If the equipment is damaged, it means that it is an indication of impairment. And E-company carried out an impairment review. At 31st March 20x7, the fair value was estimated at 45,000 and the cost to sell at 2250. The equipment is expected to generate annual cash flow of 12,500 for the next 5 years. 12,500 mean 12,500 for the next 5 years mean that the 12,500 will be same every for up to the 5 years. Mean for the first year it will be 12,500. For the second year it will be 12,500. For the third year it will also be 12,500. Means same every year. The relevant cost of capital is 12%, and the present value of the annuity of $1 for 5 years is 3.60. If the same cash flow is received at a regular interval of time, so it is known as an annuity. And if you want to calculate the present value, so directly multiply it with an annuity factor instead of discount factor, right? So now let's calculate the impairment loss. So for the impairment loss, we have to compare the carrying value versus the recoverable amount. Okay. And then the recoverable amount will be higher of, it will be higher of fair value less cost to sell and value in use. Now, if you look, the fair value was estimated at 45,000 and cost to sell is 2250. So the recoverable amount will be, sorry, the fair value less cost to sell will be 42750. Okay. Now for the value in use, the cash flow is 12,500 and the annuity factor is 3.60. Which will give you value in use of 45,000. Now, which one is the higher one? It is the value in use. It is 45,000, while the fair value less cost to sell is 42,750. So value in use is the higher one. It will become the recoverable amount for the equipment, which is 45,000. Clear? Now let's calculate the carrying value. Okay. So for the carrying value, we have a simple formula: cost minus accumulated depreciation. The cost is 120,000. Now we have to calculate the accumulated depreciation as well, right? So the useful life of the equipment was 10 years and the residual value was nil. So if we want to calculate the depreciation expense, so it will be cost divided by useful life. So a depreciation expense of 12,000 will be charged every year. Now this equipment is acquired on 1st October 20x2. So means for the year end for the year of purchase, the year end for the year of purchase is 31st March 20x3, then x4, then x5, then x6, and then now the year is x7, right? Means if the equipment is purchased on 1st October 20x2, so the year end for this purchase date will be x3, because the year end will be 31st March 20x3, then x4, 5, 6, and 7. We have to charge full depreciation in x4, x5, x6, and 7, and for 6 months depreciation in x3. So 12,000 multiplied by 4, it will be equal to 48,000, and 48,000 plus 6,000 depreciation expense for the x3. So a total of depreciation expense will be 54,000. 48,000 for this 4 years, full year depreciation for x4, 5, 6, and 7, and for x3 it will not be a full year depreciation. We will charge depreciation on pro rata basis because it is acquired on 1st October, November, December, January, February, March. So 6 months depreciation just for the x3. 48,000 plus 6,000, 54,000. Now the accumulated depreciation is 54,000. So it is 66,000. So the carrying value is 66,000. By comparing it with recoverable amount, there is an impairment expense of 21,000. So the double entry for this will be profit or loss debit 21,000, and the equipment will be credited by the same amount. So there is an impairment expense of 21,000. So this was all about the background information, the complete background information. Now let's move towards the requirement. Okay. In accordance with IAS 38 intangible assets, what amount should be recognized in the statement of profit or loss for the year ended 31st March 2007 in respect of the project or year? What amount should be recognized in the statement of profit or loss? Examiner is not asking about amortization expense. Examiner not asking about the research expense. Examiner is asking about the total expense, because they are saying that what amount should be recognized in the statement of profit or loss. But in the statement of profit or loss, research expense as well as amortization expense both will be charged, right? So the correct answer is 6.5 million. 6 million for research because the criteria was not met, and 0.5 million is the amortization. So 6 plus 0.5 is equal to 6.5 million. In relation to the plant and land, what are the carrying amount of the deferred tax liability and the revaluation surplus in equity at 31st March 2007? Already calculated. For the deferred tax liability, it is 40,000, and for the revaluation surplus, it is 128,000. So deferred tax liability of 40,000 and revaluation surplus of 128,000, option C. Next one, what amount should be recognized in profit or loss in relation to the impairment of equipment? Already calculated, it is 21,000. Look, 21,000. Okay, next one. E-company has an intangible asset that has indefinite useful life. So it should not be amortized, and it will be given for impairment testing annually. It should not be amortized. Which of the following statement is correct? The asset should be amortized over a maximum of 20 years. If it is indefinite life, so how you can amortize it over the 20 years? It is wrong. The asset should be amortized over the period management expect to benefit. The management cannot predict the total useful life because they have indefinite useful life. So it is wrong. The asset should not be amortized, but it must be tested annually for impairment. Yes, it should not be amortized and it will be tested for impairment annually. The asset should not be amortized, but be tested for impairment if indicator exists. No. Indication is for those assets. Indication is for those assets which can be amortized. Right? If you remember IAS 36, I clearly told you that purchase goodwill and those intangible assets which has indefinite useful life will be amortized, will be kept for impairment testing annually. Right? Other than that, when you get the indication, you can do the impairment testing. The last one, identify by clicking on the relevant box in the table below whether the following should be treated as a research or development expenditure in accordance with IAS 38 intangible assets. The construction of a scale model of a pilot plant. So it is a development. Pilot plant scale model means you may say a small model. Before the construction of the complete plant, you make a small model, right, just for the testing. So it is a development expenditure. Activities aim to obtain a new knowledge. New knowledge means research. Testing of pre-production prototype, it is a testing of pre-production. So it is development. The search of alternative use of product that are already manufactured. What do you think? The search for alternative use of product, the search for alternative use of product, research expenditure. So this was all about project.